Let's talk about completing a summer tax tune-up.
I'm George Dube, saving the world from tax, one bow tie at a time.
Now, I know you might all be expecting me to talk about tax, but George has put on a brand new bow tie, polka dots, just to talk about those summer tax tune-ups. And I'm going to leave it over to him now.
So I've chosen the Winston Churchill bow tie because we're going to go to war with taxes here.
Okay.
This is important stuff. Looking at the federal budget this year, again, we've used the term in the slide, very disruptive, but I want to focus on the idea of trends. This wasn't a once in a lifetime budget. This wasn't the first time in Canada that we've had some very negative aspects of the federal budget from an income tax perspective. So key to this budget was the capital gains inclusion rate going from 50% to 2/3. And what that really means behind the scenes. But again, if we look at this trend of different tax topics that have popped up over the budgets, we're seeing more and more and more focus on wealth redistribution as compared to wealth creation. And yes, it's written right into the budget documents. It's not that I'm trying to taint it, it's already tainted. So let's talk a little bit about this inclusion rate change. So again, I'm not trying to pretend that it was a good thing. Far, far, far from that.
And a lot of people were freaking out about it. I mean, rightly so.
No question. But on the positive side, what it has done, it has riled up people's attention perhaps to say, again, wait a minute, is my planning adequate? It initiated a lot of discussions from a tax planning, investment planning perspective. And I try in a lighthearted manner, maybe in some of the conversations, to say something to the effect of, maybe you weren't paying enough attention to me when I was trying to tell you that is a very, very general number. When the second of mom and dad passes away, you and your spouse, roughly speaking, you're going to give away 25% of your net worth to the government.
Which nobody likes to hear
No,
that.
it's almost unbelievable, right?
Yeah, exactly.
And now that number is a third. And so if a third of your net worth isn't worth talking about, and it's not a third of your net worth today, it's a third of your net worth when the second of you and your spouse passes away. Hopefully that's a big number.
Mm-hmm.
Third. And a third assumes a lot of tax planning has also been introduced to this. I've got literally a couple of cases right now that I'm dealing with where they are successfully doing everything wrong in terms of they're, without getting into all of the details, they're rushing to judgment in the sense of what to do after someone has passed away. They are rushing to judgment with what to do with the investments, business activities. They're not doing enough planning. They just want to finish things, get it simple.
Mm-hmm.
And what they're going to do successfully by making it simple is through a series of very, very unfortunate steps. It's quite possible they give away more than or approximately 90% of their net worth. And that's horrifying.
That seems crazy. But as a business owner myself, like, I understand the drive to try and make things simple because you're so busy in all aspects of your business. Which is why I guess I appreciate being married to you, because you can explain to me in layperson's terms why sometimes keeping it simple is actually shooting yourself in the foot, because that simplicity now, or perceived simplicity now, will cost you thousands, millions of dollars later.
Right. And part of the problem is when somebody passes away, they are deemed to have sold all of their assets for fair market value, which kind of in tax language means they're getting taxed as if they sold everything for real. And generally speaking, when the first spouse passes away, assuming that the wills are written such that everything goes to the surviving spouse, as a general comment, tax is not triggered at that point. They wait till the second spouse passes away, which intuitively makes sense, and I think is abundantly fair. But if we have the deemed disposition when the second of the spouses passes away, and we'll have clients that are starting to sell assets or take money out of corporations to give to beneficiaries or whatever, let's keep in mind we've got a tax disposition within a corporation or other entity. We have taxes triggered potentially, depending how things are set up, when those assets get out of the corporation to the individual. And if they're not done properly and it's not coordinated, we've got taxes then when the original person has passed away, taxes in the corporation, taxes to the beneficiaries. And who just won that? Well, obviously, Revenue Canada just won that.
Yes.
So it's not that it's not possible to do some of those things, but it needs to be planned and it needs to be coordinated. We can't just keep, while we're alive, postponing those decisions or saying, the beneficiaries, they can worry about it. If they get anything, it's better than nothing. And I'm not trying to say what you should or shouldn't be doing with your estate, but surely, if you had the choice of giving money to Revenue Canada, church, cancer society, family,
it's not a
there's one
choice.
clear person that's never should be selected in that group.
Yeah, it's not even a choice, really. I mean, Revenue Canada shouldn't be at the top of the list. So that seems like a bit of a heavy discussion for that Muskoka chair. But I guess I would say, like, if we're looking at the things to talk about over the summer or, through the year, when you need to really sit down and have those discussions about that tax tune-up, you can look at things like what has changed with tax rules. And of course, that's when you're going to be talking to your accountant. In my case, my husband. You're going to be talking about what's changed with your family. So, have you had another child? Has one of your children gotten married? Have you gotten married, divorced, separated? There's lots of things that could be happening there that you need to take into account. Has things changed with your business? So, for example, for us, obviously a huge change was me not working any longer full-time in the corporate world and focusing instead on our other aspects of our life. So that was a huge change. We had to have a discussion about that. Have there been changes with their financing? And I know that's obviously been a huge issue for real estate investors in the last few years, really since the pandemic, because there's been so much up and down. And then as the inflation rate's gone up and interest rates, I mean, we don't need to talk in detail about that, but that obviously has made some huge differences with financing ability. And then legal changes. And that's when you call up your lawyer and have some discussions with them as well. I know often people start with the accountant, George. I'm not sure if you have any advice on that.
And starting with the accountant, it's not that it's necessarily what I would call good or bad. The important thing is to start with somebody, one of the trusted professionals, and ensure that they are coordinating with the others and we're getting people together. And going back to your comment of perhaps a heavy topic for the Muskoka chair, if you will, I want to suggest the opposite. And that is, oh my goodness, I've got a medical practice and my loan interest is getting higher and higher. I've got some problems here, there, my real estate, my this, my that, my family, all the taxes, and it's overwhelming. But starting to talk with a couple of professionals to get from that paying a gargantuan amount of tax to something much more reasonable or even less than reasonable, if we have some opportunities to really get in there, I think it's the weight of the world off the shoulders. And, oh, this is what the Muskoka chair is for. And so I
Yeah.
think two ways of sitting on that chair, one of addressing the issues and one of, if you will, kind of being that proverbial ostrich and putting our heads in the sand.
Yeah, and putting your head in the sand won't make the problem go away because Revenue Canada is still going to be there at the end of the day. So having as much information, making as many plans as possible is really, like as you said, going to help you relax on the beach, relax by the fire. So
And relax with loved ones, right?
exactly,
I've
exactly,
taken care of things for the family. Mom and I have done this. Dad and I have done that. It's a completely different conversation, and now it merits the time to be in those Muskoka chairs.
exactly. The key message here: take some action. Schedule that tax planning call with your accounting team after you've had those conversations on the Muskoka chair, and get some plans in place. I know there's lots of things on the internet to talk about how to save taxes, how to do this. I know, George, you've got lots of videos on the channel that people can subscribe to. You've even talked about like the capital gains changes. You've got a video about, hey, it's not all the end of the world, but there are things that you talk about just with clients. I mean, I have the privilege of being married to you, so I get some of that insider knowledge, but the rest of it you save for your clients. Make sure you're with the right people. Who's sitting next to you to make sure that you're successful? And why is this so important now?
Have more questions? Please subscribe, follow, or reach out. I want all of us to have the information we need to do wonderful things.